Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 16th edition of Market Outlook. So please be sure to participate in our investor sentiment survey, and we'll send you the results around midweek. So we're certainly at an interesting point in time. We have the fiscal cliff negotiations going into extra innings here. Obviously, we should have hope for a resolution already, but people on Capitol Hill want to take it right down to the wire. So let's see what the markets are foretelling. Um, Before we get into the normal fare of looking at the S&P and Nasdaq and some of the market internals, I want to take a look at the transportation sector because that has been a sector that's sort of been coiling for a while, and it's trying to get to a breakout here. So you can see that all through 2012, while the market has been basically, had a nice, good size move, IYT has sort of had this sideways action and basically built sort of a handle on a potential uh, sort of saucer pattern right here. So if you're a O'Neill disciple, this would definitely be considered a handle on this potential cup and handle pattern. And if we look at the weekly and the monthly charts, you can see them forming a little bit more. Now, the reason why I particularly like this sector is number one, you can see that with the amount of consolidation over this whole year, if we can get through that trend line, which basically is similar to the trend line that you saw on the daily chart, but if we can get through this trend line with some conviction, let's see what the volume says here. Volume has been rather light as we sort of went into the sideways action. This is even on a monthly basis. So you can see if we can power out of this here, you got enough power to take out the all-time highs going back to 2005 or so in the transportation sector. So that's something to keep an eye on. Again, the daily pattern is telling the story. We were almost broke out and confirmed well, even with the down move on Friday. We managed to close slightly up on the day, and so here we are basically sitting at this important trend line. We're not overbought nor oversold, so we got plenty of room to move if this thing in a market takes off. This is an interesting sector. Obviously, the transport sector would indicate a growing economy. So we've sort of been in the sideways action, sitting right here at the top. So this is actually another reason for overall optimism regarding the resolution of the fiscal cliff. Now let's take a look at NASDAQ 100. This is a fly in the ointment, not acting as well as some of the other indices. Let's take a look at this. Is sort of at an interesting point. Number one, we got a death cross where the 50-day has moved under the 200. In addition, we have 2 days, both Thursday and Friday, closing under the 50 and the 200-day moving average, putting us in a bearish phase. So this is the biggest issue right here. Obviously, we need to get above the highs of last week in order to get things back in gear. You still have to contend with this death cross, so that is a mitigating circumstance here. Looking at the overall pattern here, if we take out convincingly the lows set around 64.50 or so, you can expect a correction down to the 62 level. Looking at the weekly charts, again, our 65-week moving average, that blue line here was touched, never penetrated. We have the 200-week moving average which comes in around 62.80 or so. So again, around that 62.50 to 62.80 should offer some support, and this is a pretty steeply rising 200-week moving average, so that should offer a good level of support as we attack that if we continue more correction here. And obviously the other factor here is that Apple's a big component of the NASDAQ 100, putting additional pressure on this index. Now let's take a look at the S&P, because that's doing quite a bit better. And as you can see, the S&P right now, in terms of the weekly charts, we're sitting right on the 65-week moving average. We closed a little bit under it, but basically on it, and that's relatively flat. So we're sort of sandwiched between this rising 200-week, which offers support at around the 134, 134.50 level, which coincides with that spike bottom just a couple of weeks ago. If we decide to sell off as you know, the guys on Capitol Hill continue to fiddle around and not enter into a solution. Now we're looking a lot better on the daily charts. Let's bring this into better focus here. The daily chart on the S&P is sitting just above this basically flat to slightly declining 50-day moving average. You can see we've got slightly rising 200. So, you know, there's some pretty good support down to 139. Mostly we're looking to see that the bullish market phase stays intact. So there's quite a bit of difference here. Now, in terms of the market internals, let's take a look at volume. Over here you can see that we've had some accumulation on the up days and not much distribution days on the down days. So it's telling you here that there's not heavy selling on the down days in the S&P 500. So there is a positive. Let's take a look at some of the other market internals. VIX. This is the sentiment indicator, right? So you can see sentiment basically in the middle of the Bollinger Bands, so rather neutral. One cautionary factor here is you're trading now above the 50-day moving average, but below the 200. So is this a bona fide sell signal? Absolutely not in the market. So you're sort of leaning more positive. But there's a little bit of concern as you got this. You're trading above that 50. We're just beneath the 200-day moving average. We want to see it stay mostly within these the Bollinger Bands, and you're sort of getting, as you can see, the bands are contracting here. So you're getting a squeeze, which means compressed volatility. People are not really overall. So the volatility is being compressed. And that could go on for quite some period of time. So overall, sentiment is favorable, but not as favorable as it was earlier in the week before we had the several-day sell-off towards the end of the week. Now let's take a look at some of the market internals here. McClellan Oscillator, since I was out last week, actually generated a sell signal on an intermediate term basis, which is in the process of basically working itself off by going sideways to down. So you can see the intermediate, you know, for 1 to 3 weeks, we got above that 150 level, which is sort of the overbought range, and then back down through it, which generated the sell signal basically on that day. And since then, we've sort of went sideways to down. So we're still working off of that. Now, on a shorter term basis, looking out a week or so or more, you can see that we got really overbought as I had mentioned before I had left on vacation, and basically the indicator here was we got to a pretty good overbought reading. What we like to see is advanced declines and up-down volume confirm. Interestingly enough, you got that turn down earlier this week. So you are on a short-term sell signal. So that's of interest. Short-term, definitely negative in the S&P. Also on an intermediate term basis, market internals basically showing you that the breath has run out of steam on the new highs. So interesting. The overall trend in the S&P still in a bullish phase. Market internals are telling you that the breadth and volume has run out of some steam. On the other hand, the institutional volume indicator, looking at up days versus down days, clearly giving you more for the bullish case. So you got a pretty mixed internal picture, which is not surprising considering the indecision in the markets as it's awaiting an outcome from Capitol Hill. So let's take one more look at another instrument here. I'm going to take a look at bonds. TLT. So interestingly enough, you can see on a weekly chart, interest rates still in an overall intact uptrend, right? Here's your 65-week moving average. You can see held in nicely. 200-week is still nicely up. However, we are running out of steam. We're not making very much headway. Certainly a critical level is this 120 level, 121 level, which is the 65-week moving average. Now let's go to the daily chart. You can see right here we're at an interesting inflection point. We're in a warning phase here, right? We're trading beneath the 50-day moving average, but just above the 200. If we fail this 200 this following week, that would be a sign that QE4 or whatever you want to call it has really not had much of a positive effect. The Fed seems to be running out of steam with what it can do in terms of keeping rates down. So that's an interesting thing to watch here. Certainly higher rates, at least initially, could put pressure on the market. On the other hand, if they do make a deal, it could be it could be really good for the market and sort of potentially neutral for bonds. But let's take a look. All these instruments obviously need to be traded on an independent basis. So you have this squeezing of this range here. That's really interesting. This 122 level, 122.50 is critical. That's that 200-day moving average. And also the lows put in since QE4 was sort of announced by the Fed. So that's it for now. Have a great weekend. Hope they resolve things on Capitol Hill, and our condolences to the families who were affected by the tragic shooting in Connecticut.